Ready to dive into the world of investing? Today, we're cracking open a legendary book, a Wall Street Bible since 1949. We're talking, of course, about The Intelligent Investor by Benjamin Graham.
And you know what's amazing? It's still so relevant today. This isn't just some outdated classic. Warren Buffett himself says this book shaped his whole investing strategy.
Oh, absolutely. And speaking of legends, Graham actually starts the book with a pretty humbling story. Turns out, even a genius like Sir Isaac Newton, yeah, the Isaac Newton, could make some really bad investment decisions.
Oh, totally. Newton got caught up in that South Sea bubble craze back in the 1700s. Goes to show anyone can fall for the hype, even the smartest people in the room.
That's for sure. And that's where Graham's brilliance comes in, right? He's like, hold on, being an intelligent investor isn't about outsmarting everyone else. It's about having a strategy you can really rely on. And he tells the story about a company called Savold Tire from his early Wall Street days to really bring this point home.
Savold Tire. Yeah, imagine this. It's 1919, the start of the whole automobile boom. First day of trading, the stock goes through the roof. And Graham, savvy as ever, he sees this and locks in a 250% gain.
Wait, 250% in one day? Okay, now that's a hot stock. But I have a feeling the story doesn't end there.
It does not. See, within just a few months, Savold Tire is exposed as a total fraud. The company, built on nothing, just smoke and mirrors. And that hot stock, worthless.
Yikes. Talk about a tough lesson.
Right. And it shows why Graham wrote this book, to promote a whole different way of investing. Forget those quick wins. He's all about minimizing risk, slow and steady, aiming for good returns over the long haul.
So the big question is, are you playing it safe like Graham, or are you chasing after those exciting but risky market swings?
It's the question, isn't it? Every investor has to figure that out. And to help us do that, let's break down the core of Graham's philosophy.
Because, like Graham teaches us, building wealth is a marathon, not a sprint. And we're here to give you the roadmap. So let's get into these principles, starting with what Graham actually means by intelligent investing.
Okay, so he boils it down to three main things. First up, forget those flashy stock prices for a minute. It all starts with really digging deep, doing your analysis. You have to understand a company, its business, its financials, its competition, everything.
Knowledge is power. Don't just buy into the hype. Know what you're getting into.
Exactly. And that leads us to number two, protecting yourself from losses. This is where Graham's idea of margin of safety comes in. Basically, you want to buy a stock for significantly less than it's actually worth, like getting a killer deal on something valuable.
Now that's a strategy I can get behind. But how do we actually use this margin of safety in the real world?
Think of it as a buffer, a cushion for when things go unexpected, or even for when we misjudge something.
Okay, makes sense. But what about those big returns? Shouldn't we be shooting for the moon?
Here's where Graham might disagree. He'd say that aiming for solid returns over the long run is way more reliable than chasing those quick, risky gains. Slow and steady wins the race, right?
That's a refreshing take, especially these days. But do these principles still work? I mean, the market today is a whole different beast.
That's where Jason Zweig's updates to the book come in. You see, he added commentary and examples showing how relevant Graham's ideas still are. Like he totally debunks the January effect.
The what now?
It's this idea that small company stocks always do amazingly well in January.
Oh, right. I think I've heard of that. So what's the deal with it?
Well, like a lot of market trends, once everyone caught on, it stopped working. Those small cap stocks weren't such bargains anymore, so their returns in January became unpredictable.
So the lesson is, don't blindly follow trends, even if they worked in the past.
Exactly. Zweig also talks about this idea of a magic formula for beating the market. There's a big thing from this book, What Works on Wall Street.
Let me guess. Didn't quite work out like that.
Not so much. Formulas and systems fall apart when the market changes or when everyone tries to use them.
So no magic formulas. Got it. But for the defensive investor, what does Graham recommend? How do we navigate today's market?
One of his most powerful strategies is surprisingly simple. Dollar cost averaging.
Okay, I'm all ears. Break that down for me. What's the logic behind it?
Instead of trying to time the market perfectly, which is basically impossible, you invest a set amount of money at regular intervals. It doesn't matter if the market is up, down, sideways. You stay consistent.
So when the market dips, you're buying more shares at a discount. And when it's soaring, you're buying fewer shares but at a higher price. So in a way, you're taking the emotion out of investing.
Exactly. It's a built-in way to avoid those impulsive, fear-based decisions that can really hurt your portfolio over time.
And the beauty of it is dollar cost averaging. It's not just for the pros. Anyone can do it. You don't need years of experience.
Right, right. It's all about building those good habits. Discipline, thinking long term, the things that really matter.
Exactly. And speaking of good habits, Graham's also big on diversification. Don't put all your eggs in one basket, as they say.
He is, he is. You've got to spread the risk. Different asset classes and within those classes too. Don't just bet on one thing.
So we're talking stocks, bonds, maybe real estate, and within those, not just going all in on one company or one part of the market, right?
You got it. And these days, index funds, they make it so easy to diversify. They give you instant access to a whole bunch of stocks that make up, say, the S&P 500.
So one investment, instant diversification. Now that sounds pretty defensive to me, but what about those listeners who are feeling a little more adventurous? What's Graham's advice for them?
Well, he calls them enterprising investors, the ones who are willing to really dig deep, find those hidden treasures the market's missed.
The treasure hunters of Wall Street. I like it. So where do they start their search?
One area Graham talks about is IPOs, initial public offerings, those brand new stocks everyone wants a piece of.
Right, those companies just going public. What does he say about getting in on the ground floor?
He's actually pretty cautious about it.
Yeah.
See, the thing about IPOs is the track record isn't that great. Yeah, there's some big winners, but a lot of them, they don't live up to the hype.
So, don't get blinded by the shiny new thing.
Come on.
Got it. What else does Graham have up his sleeve for these enterprising types?
He talks about this thing called networking capital. Basically, it's a way to spot undervalued stocks. Like you're peeking at a company's wallet, seeing how much cash they have on hand, minus what they owe right away.
Okay, a quick financial health check. What are we looking for here?
So Graham says, look for companies whose stock price is lower than their networking capital. Could be a sign that the market's undervaluing them. A chance to snag a deal.
Like finding a designer dress at a thrift store. I'm into it.
Exactly. And to show just how risky things can get if you're not careful, he tells this great story about Chrysler.
Chrysler, the car company. Tell me more.
Yeah, so they were a classic example of what Graham called a roller coaster stock. Up and down, all over the place. Good earnings, stock shoots up, then bam, nosedive.
Sounds stressful. What's the takeaway here?
Don't get swept up in the short-term craziness. Look past the stock price and really understand how the business is actually doing.
So, even if a company has a good track record, no guarantees, anything else our enterprising investors should watch out for?
One trap is familiarity bias. We tend to like companies we know, right? We use their products, see their ads.
Oh, tell me about it. I love their coffee. Doesn't mean I should buy their stock, right?
Exactly. Don't let your heart rule your portfolio. Got to be objective.
No more investing in my favorite sneaker brand just because I like their shoes. Check. Speaking of feelings, Graham uses this really interesting analogy to talk about how our own psychology plays into all of this. Mr. Market.
Ah, yes, Mr. Market. What a character.
So who is this mysterious Mr. Market?
Picture this. He shows up at your door every day, wants to buy or sell you stocks. Some days he's super optimistic, offering crazy prices. Other days, he's a ball of anxiety, begging you to sell low.
So he's like the embodiment of the market's mood swings.
Exactly. And Graham's point is, don't let Mr. Market get in your head. Don't let his emotions become your emotions. You do your own homework, figure out what you think a company's worth.
Don't let Mr. Market's drama derail your plan. Now that's a powerful image. But let's be real, that's easier said than done, right? We all feel those emotional tugs.
For sure. For sure. We're human. Fear and greed, they get to all of us. That's why having the right temperament, Graham says, is so important.
So it's not just about being smart, it's about being emotionally intelligent about investing.
Exactly that. You have to be disciplined. Stick to your guns, even when Mr. Market's having a meltdown.
He really knew how to make those ideas stick, didn't he?
He did. He did. And to show us how it all works in the real world, he walks us through some case studies in the book. Chapter 17, he's got 4 companies, totally different situations, shows us what to do, what not to do.
Perfect. Let's dig into those. Any that really stand out.
One that's really interesting is Realty Equities Core and Real Estate Investment Trust. 2 sides of the same coin, you could say.
Both in real estate. So what made them so different?
Okay, so Real Estate Investment Trust, they were the model of a well-run company. Solid track record, steady growth, paying dividends like clockwork. Been around since the late 1800s. Realty Equities, on the other hand, they were playing a riskier game. Lots of debt to grow fast, some pretty speculative stuff.
Swinging for the fences, hoping for that big payout.
Yep. And like a lot of those big swings, they struck out, debt caught up with them, the whole thing crumbled. Meanwhile, Real Estate Investment Trust, They just kept chugging along, rewarding their investors.
Wow, what a story. Two totally different approaches. What other cautionary tales does Graham share?
He talks about the fall of Lucent Technologies, remember them? Big tech company, everyone thought they were going to take over the world back in the dot-com days.
Lucent. Oh, yeah, what a blast from the past. What happened there?
They're a perfect example of what happens when you ignore the fundamentals and get swept up in the hype. Stock price went through the roof, but it wasn't based on reality. Then the dot-com bubble burst.
And those high-flying stocks came crashing down.
Exactly. Lucent's earnings disappeared, their stock price tanked, billions of dollars gone.
A good reminder that hype isn't a business strategy.
Right. And it brings us back to that margin of safety. That's what protects you when things get crazy, or when you make a mistake, which we all do.
That life raft, keeping you afloat when the market gets choppy. Love it. But how do we actually figure out that margin of safety? I mean, how do I know I'm getting a good price, especially these days?
That's where the real work comes in, analyzing those securities. You got to dig into a company's financials, their earnings, their assets, their debts. Understand what it's really worth.
Time to brush up on reading those financial statements then. No shortcuts for the intelligent investor.
Nope, no shortcuts. But the good news is, you don't have to be a Wall Street genius to get it. Graham's book lays it all out in a way anyone can understand.
So no matter your background, you can learn this stuff. But even if we do everything right, analyze those companies, buy with that margin of safety, ignore Mr. Market's little tantrums, we could still lose money, right?
Of course, it's the market. There are no guarantees. But like Graham says, the biggest risk usually isn't the market itself. It's us.
Our emotions, our bad habits, letting fear get the best of us.
Yep, we get scared, we sell low, we get greedy, we buy high. It's all about building that right mindset.
Thinking long-term, not getting rattled by every little thing. Solid advice. This has been amazing. The Intelligent Investor, truly a classic. As our listeners dive into the book themselves, what's one question they should keep in mind?
Good question. How about this? Are you okay with maybe not making the absolute most money during those hot market streaks if it means protecting yourself when things inevitably cool down?
Playing the long game, not chasing those quick wins.
Love it. And that's a wrap on our deep dive into the world of intelligent investing. We hope you've learned a ton, feel empowered to take control of your financial future. Until next time, happy investing.